SPMO and QQQ are two of some of the most popular names now when it comes to growth ETFs. And that's because of the solid returns that they've been providing over these years while also outperforming the overall stock market. And in this video, I'll be breaking down both of these ETFs to help you understand them and to choose one that would best fit your investing strategy. So first, let's talk about how each of these ETFs operate so you have a better understanding of how and why they choose the stocks that they hold. Kicking it off, first with QQQ, the Invesco Trust ETF. So QQQ tracks the performance of the NASDAQ 100 index, which includes 100 of the largest non-financial companies that are listed on the NASDAQ. And when it comes to the stock selection criteria for this fund, there's a few key requirements to be met, such as the company must be exclusively listed on the NASDAQ index, it must be classified as a non-financial company, and have a 3-month average daily traded value of at least $5 million. Also, a minimum free float of at least 10%, meaning at least 10% of outstanding shares are available to be publicly traded and aren't restricted. And last, it must have been listed on a market for at least 3 full months. The fund and the index are reconstituted annually and rebalanced quarterly. So it's pretty straightforward in its strategy and selection process, unlike SPMO, which works quite a bit different. And SPMO is the Invesco S&P 500 Momentum ETF. This fund is based on the S&P 500 Momentum Index, and it tracks the performance of the stocks in the S&P 500 index that have a high momentum score. Momentum leans into the idea that stocks that are performing well recently are likely to continue doing so in the near future. So a momentum strategy essentially picks up the winners and avoids or drops out the recent losers based on how they performed over a certain time period. And while this is what plays into the strategy of SPMO, there are a few steps involved. So first is that the momentum value is calculated. And this value is based on how much of the stock price has changed over the last 12 months, excluding the most recent month. Next, the momentum value is going to be adjusted further by considering the volatility of the stock to generate a risk-adjusted momentum value. For example, for a positive price change over the 12-month period, lower volatility improves this value as more stable uptrends tend to be more sustainable than volatile ones. Third, a Wins-Arise Z-score is calculated to reduce the impact of outliers, and this Z-score is what gives us the momentum score for each stock. From there, the top 20% of stocks with the best momentum scores are selected. And last, each stock, depending on which value is lower, will either have a weighted cap of 9% of the index or 3 times its market cap. Also, the fund and the index are reconstituted and rebalanced twice a year on the 3rd Friday of March and September. SPMO strategy is important to be aware of since the stocks and sectors that it's exposed to could drastically change after a reconstitution. That leads me to the exposure and portfolio of QQQ and SPMO. For QQQ, this ETF contains around 101 stocks in total. And the top holdings that make up this fund are NVIDIA, Apple, Microsoft, the rest of the Mag 7, Broadcom, and Netflix, which make up just a bit over 50% of the weight of the portfolio. As for the sectors it's primarily exposed to, is technology up top, consumer discretionary, healthcare, communications, and more. And you can see this fund is pretty heavy in tech, and its top 2 sectors essentially make up over 80% of the fund, so just something to keep in mind. As for the costs, QQQ has an expense ratio of 0.20%, costing you $20 yearly for every $10,000 invested. Side note, you could hold the mini version of QQQ instead, which is QQQM, and that has an expense ratio of 0.15%. It's basically the same, except QQQ has higher trading volumes and liquidity, which is better for traders. Now, for SPMO, I'll be going over its current portfolio, but I want to show you how its portfolio has changed since its reconstitution and rebalancing in late September. So currently, SPMO is holding 100 stocks in total, and its top holdings are in Broadcom, NVIDIA, Meta, JP Morgan Chase, Netflix, and more, making up about half of its portfolio. As for the sectors that it's exposed to, there's technology, financials, communications, industrials, and the remaining percentage spread in a few other sectors. While tech makes up about a third of the fund, it still has a nice spread of exposure to other sectors as well. All right, so let's see how much of the portfolio of SPMO changed in September. Here's the top holdings before the reconstitution on the left and the current top holdings on the right. Broadcom is currently the top holding, and Visa, Oracle, and Cisco made it to the top 10, while stocks that were dropped out were Amazon, Tesla, and Costco, which together make up about 15% of the portfolio. Moving to the sectors, we can really see the biggest changes were that technology exposure increased by a good amount, and there was a large drop in consumer discretionary, along with consumer staples by a bit. Nothing too crazy or drastic here, but I'll be talking later on some much bigger shifts that this fund has experienced in the past. As you can see, unlike a typical growth fund, SPMO doesn't lean heavily into tech. And because of the strategy of SPMO, its exposure in its portfolio could be very different after reconstitutions over time. I think this highlights that if you want exposure to growth stocks or a fund that's much more tech-leaning, then QQQ is one that you don't have to worry about the possibility of large changes in the stocks or sectors that you have exposure to. Performance is the most important part for investors when it comes to these two funds, so will SPMO or QQQ deliver the best long-term returns? For the performance, QQQ has had 5-year annual returns of around 19% and annual returns of just over 19.5% over the last 10 years. And if we zoom in more recently over just the last 12 months, it's had returns of just about 21%, so it's been doing extremely well. SPMO, on the other hand, has had 5-year annual returns of over 21% and annual returns of about 18% over the last 10 years. And if we look more recently over the last 12 months, SPMO had 24% returns. It's picked up a lot of steam over the last 2 years. Now let's compare the returns of these two ETFs over these last years to see what stands out. First, taking a look at the returns since SPMO was created in October 2015, QQQ had outperformed SPMO by quite a nice chunk, with QQQ running up even more in 2020 post-pandemic until the slump around 2022, where the returns between the two are much closer. But let's zoom in some more. If we take a look at the last 5 years, SPMO has performed much better, with the last year and a half or so where SPMO really started to break away. But let's talk about what happened after 2022, since it'll give you a much better understanding of SPMO and some key changes. While 2021 was a high growth year, it was also around the time when the inflation story really started to light up and CPI hit its peak in mid-2022. And 2022 was a horrible year for growth stocks with rising interest rates, inflation, and recession fears. 2022 caused the largest drawdown for QQQ in the last 10 years of over 32%, while SPMO had a 21% drawdown, and the allocations at the time helped out SPMO. In 2022, the main holdings and sectors that it was exposed to before September changes were financials, energy, healthcare, communication services, and consumer discretionary. And those top holdings were in Google, Berkshire Hathaway, ExxonMobil, United Health, and more. So it ended up avoiding the big hits from the drops in companies like Nvidia, Meta, Amazon, and others that you'd find in QQQ. But what happens next is important. If we compare this to the exposure at the end of 2022 and entering 2023, it shifted even heavier into energy and healthcare, cutting down financials and dropping communications and tech considerably. And after the changes in March 2023, you can see the majority of SPMO still remained in those sectors, that being healthcare and energy, with industrials up in third, making its portfolio much more value-oriented. So it was holding stocks like Eli Lilly, ExxonMobil, Chevron, and AbbVie. And you might be thinking, well, what's the big deal? Well, in 2023, that's when growth stocks were rebounding and at the start of the run-up. And SPMO, because of how its strategy functions, is going to lag, causing it to miss out on the start of reversals like this. For this reason, if we look at 2023 alone, QQQ had 54.5% in price returns compared to just 17% from SPMO. But fortunately, all wasn't lost for SPMO. Growth names like Nvidia, Broadcom, Meta, and others ended up getting picked up by SPMO thanks to the momentum that they gained in 2023 and 2024 up until now, allowing SPMO to pretty much catch up to QQQ, at least from a 5-year outlook. Both of these ETFs have the potential to provide some amazing potential returns, but there's just too many variables to say whether one would outperform the other, especially since they function so differently. I think the important takeaway here is understanding how much SPMO can change over different periods based on the market. And while its portfolio looks like a growth ETF now, depending on how the market and momentum changes, it could lean more towards value or something else. So let's talk about the benefits of QQQ and SPMO. Starting with QQQ, the first benefit is that it's a fund that's historically proven. Since its inception nearly 25 years ago, it's provided strong returns. As you can see, it has a track record of outperforming the S&P 500 for quite some time. Next would be for its exposure to top growth companies. Given that it tracks the 100 largest non-financial companies on the NASDAQ, it gives you exposure to innovative stocks and high-growth industries. It also comes with low fees. With an expense ratio of just 0.20%, it comes in much cheaper than many other growth and tech-leaning funds that are on the market. Last would be diversification, but not in the sense like a broad market fund. While currently QQQ is heavily tech-leaning, it's not solely a tech-focused fund, and it can provide exposure to top growth stocks across a few different sectors. Now let's get to the benefits of SPMO. First is that SPMO has a pretty solid risk-reward profile. The largest drawdowns that were experienced over the last decade were lower in SPMO than not just QQQ, but slightly better than the S&P 500. While at the same time, it managed to provide higher returns than the overall market did over the same time period. Next is that it has the potential for higher returns. As we've seen over these past years, its strategy of selecting the best performing momentum stocks over a period of time has provided exposure to some strong momentum and profitable stocks. Also, its momentum strategy allows it to be flexible and diverse in its holdings. Not only is the strategy selecting the top momentum holdings, but its twice-a-year reconstitution and rebalancing ensures that it's constantly adapting to the changing market conditions. And last, it has low fees with an expense ratio of 0.13%, which is nothing when you consider the great returns that it's provided. While both of these ETFs are very solid funds, they aren't perfect and they still have some weaknesses. For the cons, for QQQ, first is that it comes with higher volatility. The beta, which measures the volatility compared to the overall stock market, is 1.11. So it's a bit higher than the overall market, which is a 1, and that's what a S&P 500 fund like VU would have. Next would be that it only focuses on the NASDAQ. Since QQQ is only geared towards stocks in the NASDAQ, it's going to exclude any other stocks that are listed on other exchanges. It also comes with higher drawdowns. Now, while QQQ has had great long-term performance, that doesn't take away the fact that it comes with much more volatility, which brings about the potential for larger drawdowns. When we went through performance earlier, I mentioned how QQQ had around a 33% drawdown in 2022. So it's to be expected that this fund will take much bigger hits when faced with a downturn, recession, or changes in market sentiment. This last downside is going to be sector risk. Technology makes up a large portion of QQQ, and that's no surprise given that the growth that the tech sector has been experiencing over the past few years being primarily driven by the AI boom. Let's talk about the downsides of SPMO. The first downside would be concentration risk. A benefit of SPMO is that it can offer some decent diversification, but there could be the chance that a couple of sectors are experiencing strong momentum, and this can make the fund heavily concentrated in one or more sectors. Second would be that SPMO tends to be top heavy. By top heavy, I mean the top 10 holdings oftentimes are making up close to or over 50% of the weight of the total portfolio, like how it is now. So top holdings will have a large impact on the fund's price movements. Also, SPMO could underperform depending on market conditions. Momentum investing isn't always going to outperform, as it tends to be dependent on the current stage of the market cycle. During an expansion or bull market like we've experienced, especially when a handful of companies are experiencing uptrend for some time, these strategies are going to do very well. But if we're facing a recession or slowdown, the fund is going to struggle since this strategy is based on momentum and the recent performance of stocks. SPMO can also lag growth funds on sharp rebounds. After a rough year in 2022, the rebound in growth was huge in 2023, and SPMO missed out on a lot of this initial burst. Fortunately though, the run continued and SPMO was able to get exposure to these growth stocks to give it some explosive growth in the last year and a half or so. So which ETF should you choose, QQQ or SPMO? I think it's fair to say that both of these ETFs can provide some high potential returns over the long run, but they have two very different approaches in how they do that. These funds aren't meant to be the foundational or core ETF in your portfolio, but as an addition to further boost diversification and growth potential. QQQ does this through investing in the 100 largest stocks in the NASDAQ, which comes with a heavy tech tilt, while SPMO on the other hand is picking the best performing momentum stocks within the S&P 500 of the past year. For me, when it comes to QQQ, I view it as you're investing in a fund for that exposure to the top NASDAQ companies, while for SPMO, it's about exposure to whatever the best performing momentum stocks are at a given time period, regardless of the sector, whether it's a growth or value stock. SPMO has gotten a lot of praise for being a strong growth ETF, but remember, it could look like a growth fund today, but a year from now, it could be totally different depending on how the market changes. Whether you choose one of these ETFs or both, it ultimately depends on your investing strategy and goals, but it's important that you understand the strategies of the ETFs that you hold in your portfolio. And if you want some great alternatives, I talk about 7 high growth and tech ETFs that destroy VU when it comes to returns in this video here, or in this video here on 5 ETFs that beat the S&P 500 and QQQ. If you made it to the end, I really appreciate you watching. Don't forget to tap that like button and subscribe for more content. Keep on investing, and I'll see you in the next one.